Welcome to the deep dive. Okay, you've handed us a really interesting pile of sources today on Ethena. It's synthetic dollar USDe and the ENA token.
Yeah, there's a lot there.
Definitely. We've got the big picture stuff, the deep dives into how it works, token details, risks, which seem important here, future plans, and even some very fresh market data.
Right. Price predictions, recent news, the whole package.
So our job, like always, is to wade into all of this, filter out the noise, and really pull out the key things, maybe some surprising bits to help you get up to speed fast and hopefully have a bit of fun doing it.
Sounds good. Let's unpack Ethena.
So starting at the top, Ethena. It's on Ethereum. And the big idea seems to be creating money for crypto, from crypto, right? Like getting away from traditional banks.
Exactly. That's the core ambition. Build a crypto-native form of money, a digital dollar that doesn't need the old financial system backing it directly.
And the main thing they've built is USDD. They call it a synthetic dollar. That word synthetic already flags it as different from, say, USDC or Tether.
It's fundamentally different, yeah. It still wants to be worth $1, but it doesn't achieve that by holding dollars in a bank. Instead, it uses this hedging strategy. They call it delta neutral.
Ah, yes, the delta neutral approach.
Yeah.
Based on that cash and carry trade idea, but for crypto assets, can you walk us through what happens when someone actually mints USD? What are the mechanics?
Okay, let's get into it. So you deposit some crypto. The sources mention mostly ETH or liquid staking tokens like STETH right now.
Right.
And Ethena takes that collateral. But, and this is the key part, at the same time, it opens up short positions derivative contracts for the exact same value of the crypto it just received.
Okay, so they hold the crypto, but they also bet against it using derivatives.
Precisely. The idea is if the price of, say, ETH goes down, the value of the collateral drops, but the value of the short position goes up by roughly the same amount.
So they cancel each other out, theoretically, keeping the value stable relative to the dollar.
That's the goal. Hedging away the price risk of the underlying crypto assets to maintain that USD pegged to the dollar.
Interesting. And the sources really play up the advantages here. One is, more decentralization compared to stablecoins that depend on some company holding cash somewhere.
Right, less reliance on specific institutions' bank accounts.
And the other big one, the thing grabbing headlines, is the yield. USDD, or rather staking it, can apparently generate some significant return.
Exactly, which leads into this internet bond concept they talk about. It's basically positioning USDD as this global dollar-based savings instrument that earns yield natively from crypto markets.
Okay, that's the perfect lead-in. Where does this yield actually come from?
Yeah.
How is Ethena generating the revenue to pay out yield on staked USDD, the ISUSD?
Good question. The sources break it down into three main streams. First, there's the yield from the staked Ethereum collateral itself.
Like standard staking rewards.
Yeah, the consensus layer rewards you get for staking, plus fees from network activity on the execution layer, and also MEV, maximal extractable value, those priority fees.
Okay, that's paid in ETH.
Paid in ETH, yes. Though it's important to note, one source mentions staked ETH itself is currently only about 6% of the total assets backing USDD, and that execution layer income part. That can swing wildly depending on how busy Ethereum is.
Right, so that's one piece, maybe not the biggest piece right now. What's source number two?
This is probably the more significant one. The funding and basis spread from those delta hedging derivatives positions we talked about.
Ah, the shorts again. How do they generate yield?
Well, historically in crypto markets, especially for perpetual futures, there's often been more demand to go long to bet the price will go up than to go short.
Okay.
So to balance things out, the exchanges often have mechanisms where longs pay shorts a small fee periodically. That's the funding rate. When it's positive, people holding short positions like Ethena collect that yield.
And the sources gave some numbers on that.
They did, and it highlights the variability. Like for ETH perpetuals, the annualized yield from this was apparently around 16% back in 2021.
Oh.
But it dropped to just 0.6% in the 2022 bear market, then back up to maybe 13% or so in 2024. So it's definitely not fixed. It moves with the market sentiment.
That's a huge range. Okay, so stake ETH rewards, funding rates from shorts. What's the third revenue source?
This one's a bit different. It's fixed rewards on some of the stablecoins they hold as backing. The specific example was about $101 million in USDC as of late 2024, earning a fixed rate from Coinbase, kind of like an institutional loyalty program.
Interesting. So a mix of volatile crypto yields, market-dependent funding rates, and some fixed income from stablecoin holdings.
Yeah, the sources frame it as trying to build a diversified yield stream from sustainable sort of external market forces rather than just, printing more tokens internally.
Makes sense. Okay, let's pivot to the ENA token itself. What's its purpose in this whole ecosystem?
ENA is primarily the governance token. Holding ENA gives you a say in how the Ethena protocol evolves.
How does that work in practice? The sources mentioned a specific structure.
Right. ENA holders vote apparently twice a year to elect members to a specialized risk committee.
And the initial lineup for that committee was pretty heavyweight, right? Gauntlet, Block Analytica.
Yeah, Stakehouse, Blockworks Research, Llama Risk, Ethena Lab's own research team. The idea seems to be delegating the really technical day-to-day risk management decisions to these experts.
Well, while the token holders still hold the ultimate power by choosing who those experts are.
Exactly. Plus, if you stake your ENA turning it into SENA, you can apparently vote directly on proposals about the ENA token itself, its economics, things like that.
Okay, so let's talk about SENA staked ENA. What else does it do besides give you those voting rights?
Well, SENA is a liquid token, so you lock your ENA, you get SENA back, and potentially you could use that SENA in other DeFi protocols, though the specifics aren't fully clear yet.
And it earns rewards.
It does. Initially, the sources say unclaimed ENA from an airdrop was distributed to SENA holders to encourage people to lock up their tokens long term. And the idea seems to be that SENA will capture value from the ecosystem over time.
Kind of like how BNB works for Binance.
That's the analogy the sources draw, yeah. They even suggest that new projects building in the Ethena ecosystem might airdrop their own tokens to SENA holders.
Okay, and then there's another layer mentioned, restaked ENA. What's that about?
Restake ENA sounds like it's part of the future plans. It's meant to add economic security, specifically for cross-chain transfers of USD.
So moving USD between different blockchains.
Exactly. The sources mention this uses Layer Zero's tech, specifically their DVN system, and involves a partnership with another project called Symbiotic. This all seems tied to the upcoming Ethena network infrastructure.
And staking ENA also gets you rewards from projects building on this network.
That's the plan. They gave the example of Ethereal, a project building an exchange on Ethena, committing 15% of its future token supply to SENA holders. So multiple potential reward streams for staking.
Okay, so ENA for governance elections, SENA for liquid staking, direct voting on tokenomics, and ecosystem rewards, and then restaked ENA for future cross-chain security.
That seems to be the structure.
And the total supply is 15 billion ENA tokens, distributed across airdrops, ecosystem funds, the foundation, investors, core team.
Right. And understanding that distribution schedule, especially the unlocks for investors and the team, is really crucial context for what's happening with the price right now.
Absolutely. Which brings us neatly to looking ahead. Ethena seems to have some pretty big plans for 2025, according to the roadmap described in the sources. They're not just staying within crypto.
No, a major theme is pushing into traditional finance, or TradFi. They're planning a product called USDe.
USD, what's the I for? Institutional.
Seems likely. It's described as a regulated version of USDe, basically packaged in a way that traditional financial players, asset managers, credit funds, ETP providers, prime brokers can actually hold and use it.
Wow, those are enormous markets. What's the pitch to them? Why would a TradFi fund want something based on crypto yield?
Well, partly it's the potential for higher returns than traditional fixed income coming from those crypto-native sources like futures funding rates. But the really interesting angle highlighted is the potential for negative correlation to traditional interest rates.
Meaning when regular interest rates go down, the yield on USD might actually go up.
That's the idea. The sources cite Q4 2024 as an example. Apparently, when expectations shifted towards rate cuts, ETH funding rates jumped from around 8% to over 20%. For a TradFi portfolio manager struggling with low yields, something that might perform better when rates fall is potentially very attractive. It's rare.
That is a powerful narrative, and they see a big opportunity there.
Huge. They talk about the fixed income market being over $190 trillion, and they think USD alone could attract over $10 billion in demand fairly quickly just by bridging this gap.
Okay, so that's the institutional push. What about regular people?
They're aiming for mainstream access, too, through a planned app integrated with Telegram.
Telegram, with its massive user base.
Exactly. Over 900 million users. The vision seems to be a super simple mobile experience. Save your money in USDD, earn yield automatically, send payments easily to contacts.
Like a neobank built on USDD.
Sort of, yeah. And they even mention potentially integrating with things like Apple Pay for tap to pay in stores. So combining that dollar with yield idea with really broad, easy access.
Ambitious stuff.
Yeah.
And all this expansion is planned on top of the Ethena network infrastructure.
Right. They're positioning the Ethena network as this platform for other financial apps to build on, using Ethena assets like SUSD.
Any examples?
Yeah, the sources mention Ethereal again, that exchange, using SUSD for its order book, aiming for a testnet in early 2025. Another called Derive, focused on on-chain options and structured products using SUSD as collateral, which was apparently planning a token launch soon after the source was written.
So it feels like they see the broader economic climate, particularly falling interest rates, as a major tailwind. It could boost their core yield generation and make their products more attractive to both TradFi and retail.
That narrative definitely comes through strongly in the roadmap discussion. They see it as a potential compounding effect, positioning Ethena to capture not just existing stablecoin market share, but open up entirely new segments. TradFi savings, consumer payments, potentially bringing, they estimate, over $50 billion in new flows into stablecoins overall in the next couple of years.
That's a very bullish outlook.
Yeah.
But, okay, we have to talk about the other side. The risks. Ethena seems fairly open about them in the documentation, which is good.
Yes, they do list quite a few. Things like funding risk. What if those funding rates go negative for a long time?
Right. What if shorts have to pay longs?
Exactly. Then there's liquidation risk if markets move too fast, custodial risk with where the assets are held, exchange failure risk, a big one, risks related to the underlying backing assets themselves, stablecoin depegging risks, margin collateral risks on the derivatives exchanges, and governance risk, bad decisions by token holders or the committee.
That's a comprehensive list.
Yeah.
Let's drill down on a few key ones mentioned. That core delta-neutral strategy itself. How could it fail?
The main worry is extreme market volatility, like a sudden massive crash where the mechanisms break down. Maybe the exchanges can't handle the volume, liquidations cascade, and the short positions don't perfectly offset the drop in collateral value. That could cause USDe to depeg.
Okay. And what about the collateral itself, even if some is stablecoins, like USDC?
That's another risk, collateral concentration. If a significant chunk of the backing is in, say, USDC and USDC were to have problems in depeg, that would directly hit USD's backing value.
Makes sense. And just the general tech risks in crypto, smart contracts.
Always a factor. Bugs in the Ethena smart contracts, problems with the price feeds they rely on, issues with the exchange APIs. Any technical glitch could potentially cause problems with minting, redeeming, or the peg itself.
And even though it aims for decentralization, there's still reliance on centralized players, right? The exchanges.
Absolutely. This is a key point. The derivative contracts are held on centralized exchanges. The custody of some assets might involve centralized providers. If one of those major exchanges or custodians fails or gets hacked, Ethena could be directly impacted. It's a form of counterparty risk.
This naturally brings up comparisons to Terra Luna. People hear yield-bearing stablecoin and get nervous. How do the sources address this?
They're very clear on the distinction they want to make. They argue Terra's UST was algorithmic, relying purely on a mint burn mechanism with Olunae and an assumption about Lunae's future value. When Lunae crashed, the whole thing imploded.
Whereas USD is?
USD is collateralized and hedged. It's backed by actual assets, and the price risk of those assets is actively managed through derivatives. It's a fundamentally different mechanical structure, according to Ethena.
That's a critical difference, but there's still a major caveat highlighted, isn't there?
Oh.
The big unknown.
Yes, and it's arguably the most important risk to keep in mind. Ethena and its USD peg mechanism launched in a relatively benign or bullish market phase. It has not been battle-tested through a truly severe, prolonged crypto bear market or a major systemic crisis yet.
So we don't actually know how the delta-neutral hedge would hold up under extreme sustained stress.
Exactly. A massive, prolonged downturn could strain the funding rates, cause liquidity issues on exchanges, or trigger unforeseen problems. That's the ultimate stress test it still has to face.
Definitely the elephant in the room. Okay, let's shift to the here and now. How is the market actually treating the ENA token today, based on that news source from June 2nd?
Well, as of early June, the picture wasn't pretty for the ENA price. The article noted it was down over 20% in the preceding week and about 1% just overnight leading into June 2nd. Significant downward pressure.
And the main reason given was?
Token unlocks. Plain and simple, constant scheduled releases of more ENA tokens onto the market.
The source gave specifics on that schedule.
It did. On June 2nd, the day the article came out, another 40 million Ethena tokens unlocked, about 57% of the supply, worth around $12.5 million then. And looking ahead to today, June 5th, a much larger unlock was scheduled, nearly 172 million tokens.
Wow, 172 million. That's almost 3% of the total supply hitting the market today, valued at over $50 million.
Based on the price, then yes. And the crucial thing is, this isn't stopping. These unlocks are apparently scheduled monthly on the 2nd and 5th of each month, all the way out until April 2028.
That is a long period of sustained supply increase.
The source calls it heavy inflation, hitting the circulating supply. And it creates this really tough dynamic for the price. Even if Ethena as a protocol is growing its user base, or TVL, this constant stream of new tokens makes it hard for the price per token to go up.
The article described it as almost a lose-lose situation for the price in the near term.
Kind of, yeah. If the price stays low or drops, the inflation just dilutes existing holders. But if the price does try to rise, those unlocks become much more valuable in dollar terms, which could tempt the recipient's early investors, team members to sell, adding more downward pressure.
So that price around 0.30 cents mentioned in the article.
Yeah.
That's a long way from the all-time high.
A very long way. The high was $1.52 back in April 2024. So it was down about 80% from its peak. And the general trend had been downward since December 2024.
Okay, what about the price predictions from that CoinCodex source? Remembering, of course, this is just one model, absolutely not investment advice.
Right. Crucial disclaimer. Their technical analysis at the time pointed to bearish sentiment overall for ENA, which was interesting because the broader crypto fear and greed index was actually showing greed.
So ENA was underperforming the general market sentiment according to that model. What did it predict short term?
It predicted the downward trend would likely continue in the near future. The model suggested ENA could fall further, potentially reaching around unturned 21 cents, 22 cents by early July 2025. That would be another 25% drop from where it was. Most of their technical indicators, like moving averages, were flashing sell signals.
Okay, short-term outlook. Negative, driven by unlocks and technicals in that model. What about longer term? Did the algorithm see any recovery?
It did. Further out, the model predicted a potential turnaround, with a more bullish trend possibly emerging in 2029 or 2030. It projected potential highs back above $1, maybe around $1.24 by 2029 and $1.12 by 2030.
So potentially significant upside years down the line, according to that algorithm.
Based on its historical analysis and projections, yes. It even threw out some very long-term, highly speculative numbers, like $8.79 by 2050. But again, that's looking decades ahead.
Right. So the current market story seems dominated by the supply pressure from unlocks, creating bearish technicals, even while algorithmic models might see potential for long-term recovery if the project executes on its plans.
That seems to be the tension, yeah. The source also mentioned traders look at support resistance levels and correlation, noting ENA tended to move somewhat with the broader crypto market, excluding stablecoins.
Okay, we've covered a huge amount of ground. The tech, the revenue, the token, the big future plans, the serious risks, and the current market picture shaped by those unlocks. Let's bring it back to the listener. Why should you pay attention to Ethena?
Well, for starters, it gives you a really different way to think about stablecoins. This idea of a synthetic yield-bearing dollar using hedging, it challenges the traditional models.
Right. It forces you to ask what stability means in crypto and how it can be achieved. It also shows you how these new protocols are trying to generate real revenue.
Exactly. It's a case study in blending TradFi concepts like hedging and basis trades with crypto-native stuff like staking yields. Understanding where the yield comes from is key.
And it's a fascinating example of crypto trying to bridge into the traditional financial world with things like USDe. Watching how that plays out could tell us a lot about the future integration of these two spheres.
Definitely. Plus, digging into the risks here, the reliance on exchanges, the untested nature in a deep bear market, the specific mechanics of the hedge, it really underscores the importance of doing your homework on complex crypto assets. The risks aren't always obvious.
And finally, that ENA price action is a stark reminder of how tokenomics, especially unlock schedules, can massively influence price, sometimes more than underlying fundamentals or roadmap announcements, at least in the short to medium term.
It's a crucial factor to consider for any token investment.
So quick recap of our deep dive. Ethena is offering a synthetic dollar, USDe, backed by hedged crypto assets, generating yield from staking and derivatives. Its ENA token governs the protocol, with staking, CNA, restaked ENA, offering rewards and future utility. They have ambitious plans to enter TradFi and mainstream payments. But significant risks remain, especially around market stress and counterparty reliance. And right now, the ENA token price is heavily impacted by ongoing token unlocks, despite some models predicting long-term potential.
That covers the key points from the sources, I think. It's a project with a lot going on, both promise and peril.
Absolutely. And maybe a final thought to leave you with is this. As crypto keeps innovating and trying to connect with global finance, projects like Ethena are really pushing the definition of what a dollar can even be. But the big question remains. How will these complex synthetic yield-bearing instruments actually hold up? Not just on paper or in good times, but when faced with severe real-world economic shocks or unexpected crypto market failures, especially while grappling with the ongoing pressure of token distributions. That's something definitely worth watching closely.